Hey, good to see you. Welcome, kia ora. It's me, Econ Teach NZ, and here, look, stick around, because we're going to talk about the most powerful institution you've never voted for, probably one you didn't even think much about, all right? You didn't elect them, but they actually control your money. So let's have a look at them. Stick around. Right, this is the institution that runs your financial life, all right? There's a group of people with more influence over your daily life than the elected government. They decide whether your parents' mortgage repayment goes up or down, or your mortgage payment goes up or down. They decide whether businesses can afford to hire. They decide how much your currency is worth relative to everything you import. Your phone, your petrol, your groceries. You didn't vote for them. You can't vote them out. In most countries, they are explicitly and deliberately designed to be insulated from democratic pressure. Yes, I know. They are central bankers, and right now, there's one operating in almost every country on earth, including, if you're watching, from New Zealand, the Reserve Bank of New Zealand on the terrace in Wellington. Understanding how they came to have this power is one of the most important and underrated things you can learn in economics. Right? So let's talk now. Let's be honest about the history of central banking, because it's not boring. It's a story of financial crashes, political battles, secret island meetings, not that one, and the genuinely difficult question of whether we've handed too much power to people nobody elected. Let's go. All right. Let's have a look in time. Where did central banks come from? Let's go all the way back to 1694, the founding of the Bank of England, one of the world's oldest central banks. It didn't start as a noble public institution. All right. Kind of started, not much of a hustle, but kind of a hustle. All right. England needed money to fund a war against France. You know, those two aren't always friends. There was a Scottish financier, he was called William Paterson, and proposed a deal. A group of wealthy merchants would loan the government £1.2 million. In return, they'd receive a royal charter, a royal agreement to operate as a bank, with the exclusive rights to issue banknotes. Right, and those banknotes would be backed by government debt. The government got into its war chest, the merchants got a monopoly, and the Bank of England was born. Not from high-mindedness with regards to the public, but instead from a mutually convenient arrangement between the state and private capital. Sounds a bit on the nose? Yeah, maybe. But this is an honest origin story of most of the central banks, and it matters for how you evaluate them. Let's look at a different one, the US Federal Reserve. It was founded in 1913 and has an equally eyebrow-raising origin. It emerged after the panic of 1907, when J.P. Morgan personally had to bail out the American banking system because there was no institution capable of doing it. All right. The Fed in the US was created to prevent private institutions, private individuals, from ever having that much systematic power again. The irony, the creation was largely designed at a secret meeting on Jekyll Island in Georgia. Okay. It was attended primarily by private bankers. They were representing the very institutions that they were supposedly regulating. It's not a conspiracy theory. This is part of our historical record, right? And it is interesting every time I read it. What else can we think about? All right, let's move on in our timeline. Let's have a look at what happens in the 40s, all right, thereabouts. Central bankers began as government financiers. They evolved into something considerably more powerful, the lenders of last resort, the guardians of price stability. The lender of last resort concept was formalized by a guy called Walter Bagot. I think I'm saying that right. In 1873, his principle was straightforward. In a banking crisis, lend freely. at penalty rates against good collateral. The logic was, if everybody knows that there's a backstop, bank runs should become less likely because the panic never gets started. Confidence is self-fulfilling. This matters because there was a banking crisis in the 19th century, and that was catastrophic and sometimes quite frequent. The US had major banking crises in 1873, 1893, and again in 1907. Without a lender of last resort, a single bank failure could actually cascade through the entire financial system within days. The second evolution then was this idea of inflation targeting. It's more recent. Up until around the 1970s, most central banks managed their exchange rates under a system called the Bretton Woods system. When that system collapsed in 1971, inflation started spiraling around the developed world, right? All the way through the 1970s. Central banks needed something as a new anchor. So inflation targeting, where you were to set a specific goal for the rate of inflation and then adjust interest rates to try and hit it, then became the dominant framework from the 1980s onwards. Now, here we go. New Zealand actually was a pioneer here. The Reserve Bank of New Zealand introduced formal inflation targeting in 1990. This is before the Bank of England, before the US Fed, before almost anyone else. The RBNZ was genuinely at the cutting edge of monetary policy design, not something that comes up enough or at all. The common idea behind inflation targeting is elegant. If the central bank commits credibility to keeping inflation low, then people will expect that. All right? Your expectations will help keep inflation low. Workers don't then demand massive wage rises, businesses don't preemptively hike prices, and you get the self-fulfilling equilibrium of price stability. It is essentially institutionalized expectation management. And it mostly worked up until, 2021. In 2021, as we remember, we had supply shocks, and post-pandemic stimulus made it look considerably less robust. So, what is our central question? All right? I don't know why that's moved on. Sorry, my computer decided to do something all by itself. AI, I don't know. All right. Is central bank independence the best thing to have? Is it actually democratic? Let's question the textbook, all right? Let's have a look at it, and we'll immediately perhaps maybe sidestep some thoughts, all right? We'll see. Central bank independence is justified on the grounds that politicians, if they're left in charge of monetary policy, they would cut interest rates. And they'd do that before elections in order to juice the economy short term and create more long-term inflation. All right? We don't want that. Unelected technocrats with long terms can actually take a longer view because they don't need votes. This is the credibility argument, and there is solid cross-country empirical evidence behind it. Countries with a more independent central bank do tend to have lower inflation over the long run. But here's the legitimate counter-argument, and engaging with it honestly is what separates descriptive answers from evaluative ones. Monetary policy is not politically neutral. When a reserve bank raises their interest rates, mortgage holders will suffer. Right? When the rates stay low for, say, a decade, savers are penalised whilst asset owners benefit. These are distributional choices about who will win and who will lose. They're being made by people who aren't necessarily accountable to anyone. Who might actually lose. The counter to this, look at the countries where politicians have taken control of monetary policy. Good example, Turkey under President Erdogan. Under him, he repeatedly pressured the central bank to keep rates low, despite rising inflation. Right? Orthodoxically, when you raise interest rates, you're going to be fighting inflation. You'll do that. But he believed the opposite. The result of this was that the Turkish lira lost around 80% of its value between 2018 and 2023. Argentina's long history of political interference in its central bank is essentially another textbook case study in how not to run monetary policy. So where does that leave us? Both sides have got genuine points. The right answer will depend again on context, on the institutional design and the political environment. A student who can articulate both positions compellingly before reaching a qualified judgment will always outscore a student who picks one side and then ignores the other. We're not talking fence sitting, we're talking intellectual precision. Central banks are amongst the most consequential and least understood institutions in our modern economies. So understanding their histories, where they came from, what they were designed to do, and where the democratic tension genuinely lies, makes you a sharper economist and a more informed citizen. I'm Econ Teach NZ. Please like, comment, subscribe, but comment, should a central bank actually be accountable? Yes or no? Justify it economically, and I'll engage with the best ones. Please remember to subscribe, right? We are aiming to get to 20,000. We're close, just got a few more to go and check this one out. Next week, we're going to round out the series with what I think is probably the most interesting question of all. What comes after money? And the answer is closer and weirder than we might think. So what comes after money? Should central bankers be elected? That's our question, all right? Make an economic argument. Thank you for listening. Hei kōrera, have a great day.